The traditional path to wealth building through real estate in Australia, the one that every single buyer's agent, every mortgage broker, every financial influencer has been selling you for the last 20 years, is probably the most broken right now than it has ever been. And in this video, I'm going to show you exactly what has changed, exactly what it costs you, and exactly what the people who understand the shift are doing instead. Because here's the thing, I'm 23 years old, I manage over 50 properties in Melbourne, Australia, and last month my business did over $350,000 in aggregate booking revenue. And I don't own a single one of these properties. And the reason why this matters right now, specifically in 2026, is because every single change that the government has just made has made traditional investing more obsolete than ever. So whether you're someone who already owns an investment property or someone who's planning to buy one, or even someone who's just trying to figure out how to build wealth in this country without a 30-year mortgage behind them, this video is for you. Let's get straight into it. Okay, so what actually changed within the federal budget on May 12th? Before we actually talk about what you should do, you need to really understand what actually happened, because most of the coverage around this has either been too technical or too vague. So the federal budget introduced fundamentally two major changes that directly impact property investors in Australia. Change number one is negative gearing is now completely gone and out of the picture. Now, I've never been a fan of negative gearing in the first place, but if you're not familiar with what it was, I'll explain it real quickly. If your investment property was losing money every single month, which most of traditional property investments were, you could actually take that loss and then offset it against your own income tax. So let's say you're earning $120,000 a year from your job and your property was losing you $15,000 a year, then you would only get taxed on $105,000 in income. The government was essentially subsidizing your loss. And for a long time, this made a cash flow negative property feel somewhat manageable. You were losing money on the property, but saving money on your tax bill. So the net effect felt acceptable. Now that is completely gone. So if your property is losing you money every month after the mortgage, after the insurance, council rates, strata fees, then now that's just a loss. So there's no offset, there's no subsidy. It's just money out of your pocket every single month with no tax benefit to soften the blow. Change number two, the 50% CGT discount has now been completely scrapped. CGT stands for capital gains tax. And the way it worked before this budget is that if you held an asset for over 12 months, including an investment property, and then you sold it, you were only taxed on 50% of the gain. So if you bought a property for, let's say, $600,000, and then you sold it for $900,000, your taxable gain wasn't $300,000, it was $150,000 because of the CGT discount. The government was cutting your tax bill on exit in half. That discount and that tax relief is now gone, which means that when you eventually sell the asset after years of holding it and after years of probably bleeding cash every single month, you will now get taxed on pretty much the full capital gain of that property after an inflation-based adjustment. So let me pull both of these changes together for you. Before this budget, you were losing money monthly, but getting a tax break on the loss. And when you eventually sold, you got to keep more of the gain. The government has now removed the support at both ends simultaneously. That is a fundamentally different investment proposition. And I personally think that most Australians haven't fully understand or fully wrapped their head around what this actually means for their finances yet. Let me actually break down the numbers for you. Let's say you've saved $120,000 and you've been disciplined, you've been patient, and you've done what everyone else told you to do. Now you're ready to invest it. The standard advice is to use that $120,000 as the 20% deposit to purchase a $600,000 property. And then you take out a mortgage on the remaining $480,000. And now you're a property investor. The average gross rental yield on residential property in Australia is 3 to 4%. On a $600,000 property, that's roughly $23,000 a year in rent, or about $1,900 a month coming in. But after all your holding costs, you're spending somewhere between $3,200 to $3,600 a month. So that's a loss of $1,300 or $1,700 every single month. And before this budget, you could actually offset that against your own income tax. That mechanism is now gone. And then when you eventually sell the property, let's say the property grows to $900,000, you're now taxed on the full $300,000 gain, adjusted for inflation, instead of half of it. And depending on your income, you could be paying up to 47% tax, which is $141,000 on that $300,000 gain. And here's what that actually means in practice for the average Australian who's been following this path. That $120,000 deposit, that represents years of work for most people, a decade of disciplined saving, and the assumption underneath all of it was that property was always going to be a safe bet. The thing that you do when you're serious about your financial future. And what this budget has essentially done is actually put a question mark over an assumption that most Australians have never had the reason to question before. And I'm not necessarily saying that investing in property or investing in real estate in Australia is now worthless. I'm saying that the tax environment that was built around this federal budget makes buying a cash flow negative property feel no longer manageable. So the honest question that's worth sitting with now is whether or not the traditional real estate investing method is worth pursuing now. The answer to that question is going to be different in 2026 than it would have been 2 or 3 years ago. So if traditional property investing in Australia doesn't stack up the way it used to, then what actually does? And I want to be honest here because there is no perfect answer to this question. Every option that you could choose in this industry has trade-offs, but I think it's worth laying them all out clearly on the table because most people never really do that. So with that being said, option 1 is you stay the course. You buy the property, you take on a mortgage, and then you hold it and wait for capital growth. The upside is that property markets in Australia has historically moved upwards over long periods of time. The downside is everything that we just talked about. You're cash flow negative from day one, the tax support is now gone from the federal budget, and you're locking up a significant amount of capital for a single liquid asset for a long period of time. Now, in my personal opinion, if you were ever to buy a property in Australia, I would go with a commercial property rather than residential asset, just because the cash flow is better, it's probably going to be positively geared, and most of the time you still end up with significantly higher capital growth. But if you're ever to buy a residential property, make sure that you buy it within a corporate structure and keep a 25% tax environment rather than buying it in your personal name. This is probably the biggest mistake that people will still make. Option 2 is something like investing in shares or index funds. Reasonable long-term returns is still liquid and there's a lower barrier of entry. But generally the issue that most people run into isn't the returns, it's the behavior. Because ultimately watching a portfolio drop 30 or 40 percentage point requires a lot of emotional and mental discipline. And in most cases, I see a lot of people not be able to handle it. Finally, option 3 is building an active trading business that produces you cash flow rather than buying an asset and waiting for it to appreciate. Now, this is the method that I want to spend the rest of this video on. Not because it's the most obvious choice for everyone, but because it's the least understood option of the 3. And given what's just changed in the federal budget, I think it deserves a much more honest look than it usually gets. Now, I'm not saying that this option is going to be for everyone. You actually have to put some time and work and effort into this part, and it's not a passive operation, but it will yield you much higher returns. And you can actually control your income rather than waiting for capital growth that you can't control. So what does building a cash flow operation actually look like in practice? Well, the model I use is called rental arbitrage, and the concept is very straightforward. Basically, you find a property, you get the landlord's written permission to sublet it on short-term rental platforms, and that permission gets built into your lease agreement, or you get a written approval from the agent or property manager themselves. You furnish it, you list it on Airbnb, and then guests will book it at a nightly rate, and you keep the difference between what they pay you and what you pay the landlord in rent every single month. So there's no mortgage, there's no bank approval, and there's no large deposit that's sitting tied up in a single asset. I'll actually give you an example from our portfolio. So there is a property that we have which is a 3-bedroom in South Bank, Melbourne, and the landlord was asking for $1,200 in rent every single week, which equated to about $5,000 in rent every single month. We then took on the lease and put the property up on Airbnb and listed it for around $400 to $500 nightly. Obviously, this daily rate will depend on what season of the year it is and if you have events on and different demand factors. And in those 12 months, we made $145,000 in revenue, minus the rent, cleaning, and other expenses. We pocketed over $40,000 in profit from one property in 12 months. Now, that is obviously one of the top performers in our portfolio, but a conservative property can net you anywhere between $15,000 to $25,000 per year, depending on how well you furnish it, depending on how well you do your listing optimization and your pricing as well. Let's put option 1 and option 3 side by side and do a comparison real quick. So option 1 is either you buy a property, and let's say it's a 2-bedroom in Melbourne, that'll be roughly $600,000 to $700,000. Now, the rental yield for this type of apartment is actually not bad. It's about 5%, but it still means that you're losing anywhere from $500 to $1,000 on the long-term rental market. And remember, because it's an apartment, there's probably going to be zero capital growth inside of this asset, so there's no benefit there. It also probably cost you $120,000 as a 20% deposit just to get your foot inside of this apartment. But using the rental arbitrage model, you can control that exact same asset for an upfront cost of $12,000 or less, and produce $1,000 to $3,000 profit every single month with the same asset. Now, that is by no means a small difference. One is losing you money, $500 to $1,000 a month, and one is gaining you $1,000 to $3,000 a month, depending on how well you run the operation. But with that being said, it's crucial to note that rental arbitrage itself and running a short-term rental business is not a passive investment. You have to be able to put in the time, the effort, and the skills to bridge the gap between a long-term rental and a short-term rental. And here's the part that I think most people haven't fully connected yet. The two changes that we talked about, which is negative gearing and the CGT discount, both specifically target property ownership. They apply to people holding a mortgage asset on their balance sheet who will eventually sell it for capital gain. Rental arbitrage doesn't involve any of that. There's no mortgage, so there's no negative gearing to lose in the first place. The properties are positively geared themselves from day one, so offsetting a loss was never part of the equation. And we don't own any assets, so when we exit a property, we're just ending a lease, not selling something. So there's no capital gain and there's no CGT involved at all. Every single change in that budget that restructured the traditional property investment model, structurally none of it reaches this one. And there's also something else that's worth noting that doesn't get talked about enough. The budget has actually improved the landlord conversation for arbitrage operators. Think about it from a landlord's perspective right now. Their investment property just got more expensive to hold. The tax benefits they relied on are now gone. Some of them are questioning whether the whole thing is worth it. And into that environment walks in a professional operator offering guaranteed rent, professional cleaning, and a maintained property with none of the regular tenant headaches. That conversation is easier to have today than it was 2 years ago. The conditions that used to make landlords hesitant are the same conditions that are now making them way more receptive. That's a genuine shift that I've noticed in my business that most people and other operators haven't picked up on yet. Now, don't forget that this operation is not passive income. Not at the start. There is real operational work involved, and the people who come in expecting otherwise are usually the ones that struggle and walk away. When me and my business partner started, we actually cleaned every single property by ourselves. We answered every single guest message and took every single call manually. And we did that deliberately because we needed to understand every single part of the operation before we could build systems around it. But here's the thing, that phase only lasts as long as you let it last. Because at some point, the operation only grows to where you become the bottleneck of your own business. You physically cannot clean properties and sign new leases at the same time. You cannot answer guest calls and be on call 24/7 and acquire new properties at the same time. At the moment that you try and do both, everything suffers. The decision that changed everything for us was making the call to hire cleaners and then also hand off guest communication to our virtual assistant. This is how you actually scale the model. It's not glamorous and it's not instant, but it's systematic. And systematic is what actually compounds over time. Okay, so let's bring all of this together. The budget changed two things that fundamentally altered the traditional property investment model forever. Negative gearing is gone and the CGT discount is gone. You are paying more to hold a cash flow negative asset and keeping less when you exit. The question that raises, and it's honestly one that's worth sitting with, is whether the strategy most Australians have defaulted to for decades still makes sense in this specific environment. Not in general, not historically, right now, with these numbers and these new rules. Okay, so if you're watching this and you already own an investment property and you bought it before the federal budget on May 12th, then these new rules do not apply for you. But for someone who hasn't bought their property yet and is deciding what to do with their savings, honestly, the gap between the traditional pathway in real estate and the alternatives have widened significantly in the last few months. Rental arbitrage isn't the right answer for everyone. It requires operational effort, it requires learning a new skill set, and like any business, it has real risk that needs to be managed. But structurally, in terms of cash flow, capital efficiency, and exposure to a new tax environment, the comparison is difficult to ignore. The people generating real cash flow from property right now aren't the ones that are waiting for capital growth. They're the ones who figured out how to build an operation inside the property market rather than waiting for the market to do the work for them. Whether that's the right move for you depends on your specific situation, but I think it's worth understanding the option properly before making any decisions either way. If you want to go deeper on how this actually works in practice, how to find your first property, how to approach landlords, and how to get your listing live and profitable, I put together a free guide that walks through all of it. The link for that one is in the description. And if you want to see how I'll build this from scratch in 2026, every decision, every system, every mistake I would avoid, that's the next video that you should watch right here. I'll see you there.